On Black Friday in 2011, the most critical shopping day of the American retail calendar, a full-page advertisement appeared in the New York Times featuring a high-performance fleece and a stark, counterintuitive headline. The text simply read, "Don't buy this jacket." In an industry entirely dependent on relentless volume and planned obsolescence, explicitly telling consumers to walk away from a purchase represented a staggering breach of conventional retail logic. Yet, this aggressive anti-marketing maneuver did not suppress revenue. Instead, it triggered a massive surge in sales, permanently cementing a unique competitive advantage for the Patagonia brand. This was not a superficial publicity stunt, but rather the public manifestation of a deeply ingrained corporate philosophy that weaponized environmental activism as a core business strategy. By asking consumers to consider the ecological cost of their purchases, the company forged an unparalleled psychological bond with its target demographic. The strategy filtered out casual shoppers while radicalizing brand loyalists, proving that an ethical posture, when executed with absolute authenticity, can function as a highly effective mechanism for lowering customer acquisition cost, or CAC. The architectural foundation of this billion-dollar ethical brand was laid decades earlier, far from the boardrooms of traditional apparel conglomerates. Yvon Chouinard, a dedicated rock climber, initially built his enterprise by forging reusable steel pitons in a backyard shed. By 1970, Chouinard equipment had become the largest supplier of climbing hardware in the United States. However, the very success of the enterprise was destroying the natural resource it relied upon, as the repeated hammering of steel pitons irreversibly scarred the rock faces of Yosemite Valley. Confronted with the physical degradation of their primary environment, the leadership team made a decision that defied standard economic rationale. They chose to actively phase out their core product, which accounted for roughly 70% of total revenue at the time. In its place, they introduced aluminum chocks that could be wedged into existing cracks by hand, leaving the granite completely unaltered. This willing cannibalization of a highly profitable cash cow established a permanent precedent for the organization. The transition was fraught with immense financial risk, requiring the re-education of a highly specialized consumer base. Yet, the climbing community ultimately embraced the new, non-destructive hardware, rewarding the company with intensified loyalty. This early victory validated a dangerous but lucrative hypothesis. It proved that prioritizing ecological preservation over immediate short-term profits could actually secure long-term market dominance by establishing an unassailable aura of authenticity. Despite holding a monopoly in the niche hardware sector, the inherent margin limits of manufacturing steel and aluminum gear severely constrained capital accumulation. To subsidize the low-margin hardware business, the company began importing rugged, heavy-duty rugby shirts from Scotland, repurposing them as durable climbing apparel. The thick fabric prevented abrasions against the rock, and the collars kept heavy gear slings from cutting into the climbers' necks. This rudimentary foray into soft goods revealed a vast, untapped commercial landscape with significantly higher profit margins. Recognizing the need to separate the high-risk hardware division from this burgeoning clothing line, a new entity was formalized in 1973. Named after the rugged, mountainous region of South America, Patagonia was born, utilizing the cash flow from imported apparel to fund broader innovations in outdoor gear. Throughout the 1980s, the brand experienced explosive, almost uncontrollable expansion, consistently logging annual growth rates of up to 50%. This hypergrowth strained the operational architecture of the company, leading to bloated inventories, inefficient distribution networks, and a dangerous detachment from their founding principles. The organization was rapidly transforming into the very type of conventional, consumption-driven corporation its founders had originally sought to escape. A severe macroeconomic downturn in 1991 abruptly halted this reckless trajectory, plunging the enterprise into a severe liquidity crisis. Forced to lay off 20% of the workforce to avoid outright bankruptcy, management was pushed into a brutal period of introspection. The crisis served as a forced structural reset, prompting leadership to deliberately throttle future expansion and implement a philosophy of managed, sustainable growth that prioritized resilience over sheer scale. With a stabilized balance sheet, the firm turned its analytical focus toward the hidden externalities of its own supply chain. An independent environmental audit commissioned in the early 1990s delivered a shocking revelation regarding their most utilized raw material. The conventionally grown cotton used in their core product lines was heavily reliant on toxic pesticides and synthetic fertilizers, making it arguably the most environmentally destructive fabric in their entire portfolio. In response to this data, the executive team issued a sweeping, non-negotiable mandate in 1994. The company would transition its entire cotton supply chain to 100% organic cotton within 18 months, or they would cease manufacturing cotton products entirely. At the time, the global organic cotton market barely existed, lacking the necessary agricultural infrastructure, processing facilities, and distribution channels to support a major international apparel manufacturer. Executing this mandate required dismantling and rebuilding their sourcing network from the ground up, resulting in severe supply chain friction and significantly elevated production costs. The raw material expenses tripled, forcing the brand to absorb lower margins while simultaneously raising retail prices. Competitors viewed the move as corporate suicide, assuming the consumer market would flatly reject the premium pricing required to subsidize purely environmental considerations. However, the broader industry fundamentally misunderstood the evolving mechanics of brand equity. By openly communicating the reasons behind the price increases and educating the consumer on the ecological devastation of conventional agriculture, the company transformed a supply chain liability into a powerful differentiator. The higher price point became a badge of ethical participation for the consumer, effectively insulating the brand from the race-to-the-bottom pricing strategies of conventional retail. While the global apparel sector became increasingly dominated by fast fashion conglomerates optimizing for rapid turnover and planned obsolescence, this outdoor outfitter moved in the exact opposite direction. They anchored their value proposition on extreme durability, guaranteeing their garments for life. In a market flooded with disposable clothing, engineering a product designed to outlive its owner represented a radical form of disruptive innovation that competitors fundamentally could not replicate without destroying their own high-volume business models. This commitment to longevity was eventually formalized through the creation of a dedicated repair infrastructure, which evolved into the Wornwear program. The company established the largest garment repair facility in North America, actively encouraging customers to fix their damaged gear rather than purchasing replacements. They deployed mobile repair trucks across the country, mending zippers and patching tears on any piece of clothing, regardless of the original manufacturer. By subsidizing the repair of aging products, the brand effectively redefined the concept of customer lifetime value. Instead of extracting recurring revenue through forced upgrades, they extracted recurring loyalty. A consumer who spends $50 to repair a 10-year-old jacket develops an emotional attachment to the brand that no conventional marketing campaign can buy. This strategy transformed the actual physical garments into long-term, tangible advertisements for the company's core ethos. Beyond product engineering and supply chain logistics, the organization sought to institutionalize its environmental commitments through rigorous financial mechanisms. They implemented a self-imposed earth tax, pledging 1% of total annual sales, not just profits, to grassroots environmental organizations. This mechanism ensured that ecological philanthropy remained a fixed operational expense, completely decoupled from quarterly earnings fluctuations or executive bonus structures. Maintaining this level of capital allocation toward non-revenue-generating activism required absolute autonomy. The founders steadfastly refused to pursue an initial public offering, or IPO, recognizing that the fiduciary demands of public shareholders would inevitably force compromises on their environmental mandates. By remaining a closely held private entity, they shielded their strategic architecture from the relentless short-term pressures of Wall Street analysts and activist hedge funds. This private structure allowed the firm to deploy its corporate weight in unprecedented political arenas. When the federal government attempted to drastically reduce the size of the Bears Ears National Monument in Utah, the company did not simply issue a passive statement of concern. They blacked out their homepage with a stark message declaring the administration had stolen public land, and immediately filed a federal lawsuit against the President of the United States. Engaging in direct partisan litigation is universally considered a catastrophic risk in traditional corporate communications. Yet the lawsuit generated massive global media coverage, framing the company as a legitimate defender of public resources rather than a mere manufacturer of outdoor goods. The resulting surge in organic traffic and customer acquisition far exceeded the legal costs, proving once again that aggressive, principled stances could drive massive commercial momentum. The ongoing paradox of this enterprise is that its aggressive anti-consumerism continuously fuels its financial expansion. Every time the leadership team has prioritized an environmental principle over a clear path to profit, the market has rewarded them with increased market share. They have successfully decoupled brand growth from volume growth, proving that consumers will pay a significant premium for absolute, uncompromising integrity in an otherwise cynical retail landscape. As the founders entered their 80s, the most critical strategic challenge became the preservation of this unique corporate architecture. The standard avenues of succession, such as selling to a private equity firm, merging with a larger conglomerate, or taking the company public, all guaranteed the eventual dilution of the environmental mission. The fiduciary duty to maximize shareholder return would legally mandate the dismantling of their costly ethical supply chains and philanthropic commitments. In 2022, with the enterprise valued at roughly $3.0 billion, the leadership executed a structurally unprecedented maneuver to solve this succession crisis. The Chouinard family irrevocably transferred all voting stock to a newly created purpose trust designed solely to protect the company's values. Simultaneously, 100% of the non-voting stock was donated to the Holdfast Collective, a nonprofit organization dedicated to combating the environmental crisis and defending nature. This radical restructuring effectively removed the company from the traditional capitalist paradigm of wealth accumulation. All annual profits not required for reinvestment into the business are now distributed as a massive dividend to the collective, transforming a massive apparel empire into a perpetual funding engine for environmental activism. It represents a total structural rejection of shareholder primacy, offering a new blueprint for corporate governance. The trajectory from hand-forged pitons to a globally recognized apparel behemoth demonstrates that ethical business practices are not inherently detrimental to profitability. By treating environmental responsibility as a rigorous operational discipline rather than a marketing veneer, the organization built an impregnable competitive moat. The ultimate legacy of the brand lies not just in the sustainable apparel it produces, but in its relentless, multi-decade proof that a company can prioritize the planet and still achieve staggering financial success.